All right, it is 1:30 and we got a lot to cover. I guess the good news is if we don't get through all of it today, then we can actually know we need to get through all of it today because of homework. Yeah. So yeah, there's no good news. We just have to get all through all today. So let's go ahead and finish up what we talked about on chapter 10. Remember, we stopped on chapter 10, we started talking about confirmations. Now, confirmations we're already familiar with because we've talked about audit evidence, and we know by definition audit confirmations are third-party request. More specifically, the definition we're going to go with confirmation is type of evidence that is direct written response from a third party to the auditor in paper form or by electronic or other medium. The book tends to talk a lot about paper form confirmations. Those, practically speaking, do not get used that much nowadays, but they still occasionally will come up, especially in private company audits where you're dealing with small clients, small customers or small entities that are doing business with our clients. So confirmations can still be relevant. They can address more than one assertion. If you remember from the spreadsheet that I gave you, that confirmations, practically speaking, can address all of the assertions that we're concerned about. That being said, confirmations tend to provide different levels of assurance for different assertions. So we are in the revenue chapter, which generally speaking for revenue, we're going to be talking about how we use confirmations for testing accounts receivable. And what is probably our biggest concern about accounts receivable? Is that the client is generate fictitious accounts receivable, whether this be with their existing clients or fictitious clients. They're creating accounts receivable that don't actually exist. All right, so we're going to be very concerned about the existence assertion here. The nice thing about confirmations, though, is it doesn't really matter what our primary assertion is. We can test multiple assertions simultaneously. So we can actually get evidence on cutoff, completeness, and valuation assertions. Cutoff is interesting because even though traditionally speaking, confirmations only test account balances, we can still test a transactions and event assertion using confirmations, just simply because of the timing aspect. It's very, very rare that we do that, but for the most part, it's again, when I say confirmations can test multiple assertions simultaneously, they're very versatile in that regard. They are very specific as far as who we can actually talk to, because we have to identify the third party that's going to be relevant. But as we're going to see, we're going to use confirmations in a lot of different contexts. The most important thing to know about confirmations is when we're using confirmations to test an asset, generally speaking, we're mostly concerned about the existence criteria. We use confirmations to test a liability or an equity account. The most important assertion we're concerned about is going to be testing completeness. And we'll talk a little bit about that when we get to the purchasing process. Now, what type of confirmations are we concerned about here? Well, there's two general confirmation categories. The first is a positive confirmation. A positive confirmation basically says that a customer is going to respond indicating that they agree with the amount or they disagree with the amount, regardless of whether the situation is. So we as an auditor send a confirmation to the customer and we say, here's the balance that the client says you owe. Please respond with please provide a response as to whether you agree or disagree with this amount. If you disagree, tell us the amount that you think that you owe. All right. Positive confirmation, generally speaking, we're going to make sure that we get a response no matter what. That's the goal. All right. That's the hope. Negative confirmation is a little bit different. Negative confirmation basically says only respond if you disagree with the amount that we sent out. So negative confirmations are a little bit more lenient. If we have a negative confirmation where a customer doesn't respond, then we assume that the customer is naturally saying, I agree with that amount, no response is necessary. Now, it's very interesting. When we think about assurance that's provided through positive versus negative confirmations, which do you think would provide more assurance to the auditor? Positive confirmation or negative confirmation? A positive confirmation, because we're requesting a response no matter what. In a negative confirmation, it's possible the client or the customer that we send the confirmation to could just ignore the confirmation, toss it in the trash. We would take that as meaning the number is correct. So negative confirmations are generally only used when we don't need a lot of assurance about what it is that we're inquiring on, okay, or we're trying to get information about. That being said, positive confirmations are generally the more frequently used of the two. They do provide higher levels of assurance. Again, just for valid reasons, just because they do provide information in any context. So there's a lot to know about the procedures associated with confirmations, and we're going to go through it pretty quickly, but we do want to make sure that we're clear on all of these. So we can confirm at either an interim date at year end. It's important to note that if we confirm at an interim date, generally speaking, we have to do follow-up confirmations at year end. So if we do some confirmations at interim to test account balances, we do have to validate the final balance with year-end confirmations. It's very, very rare that we use interim confirmations only. Confirmation requests should be sent early in the engagement to maximize the response rate. In fact, if you ever work on an audit engagement, one of the very first things you start working on after you get the trial balance is you start trying to identify what confirmations you need to send out for various accounts, for accounts payable, for accounts receivable, for investments, for cash. All of these areas are things that confirmations are very, very popular on, or popular for use for. We generally try to send those out within the first few days of the engagements because we want to make sure that the third parties we're requesting information from have time to respond. The auditor must maintain control over the confirmations. In electronic confirmations, this is not nearly as much of an issue, but this used to be a major issue 20 years ago when we're using paper confirmations almost exclusively. And the logic behind that is pretty sound. Let's say I'm an auditor, I send a confirmation to a client, say, here's what you think that the client says that you owe them. Could you please respond? And the customer says, all right, writes down the number, said, I agree with this amount. Or sorry, I disagree with this amount. This amount is way too high. I think that they're overstating what was owed. And they mail it back to the client instead of send it back to us. What can the client do in that situation? Could it be possible the client can manipulate the confirmation if they're the ones to receive it? Yes, it has. Yes, it can, and it has happened in the past. If the customer sends the confirmation back to the client has the opportunity to change the information. They may say, "Oh, the customer says that they don't owe us the amount of money. We're going to change it and say this confirmation is exactly correct." Okay, so you're going to erase the customer's comment and say everything looks good. All right. So that's why we as auditors have to maintain control of the confirmations. Any direct communication needs to come directly from to the customer or the third party directly to the auditor. It needs to be a direct line of communication. If the client gets involved in that communication path at any point, the confirmation is considered to be invalid. When the auditor should record when the confirmations are mailed, when they're returned, and we need to follow up on any unreturned confirmations. This is a really important one that the auditors have gotten a lot of trouble with. When we identify the parties that we're going to be sending out confirmations to, if we do not get responses, we have to continue following up to try to get responses. So if we know that there's a party out there that's just not responding, we're going to say, hey, we sent you a confirmation. Please make sure you reply. We'd like to get follow-up. And presumably the third party will say, oh, they're really serious about this. We'll respond the second time. There are situations where a customer will not respond. One example would be if it's a fictitious customer and you send a confirmation out, then they're not going to reply with a response saying, oh, everything looks good. We're going to send you a confirmation. If they don't exist, they can't respond, which is something that's a red flag for the audit team, which is why we try to make sure we get confirmations back. We can't just ignore confirmations that we don't receive responses on. We have to insist upon getting confirmation responses. That being said, we do have a few situations or a few circumstances where we can bypass that, but we'll talk about that in a second. Each confirmation exception should be examined by the auditor to determine the reason for the difference. So when we get a confirmation back, we're going to look and we're going to see what is the amount of the difference that the customer or the third party recorded. And we're going to determine, is this a legitimate difference or is this just simply a timing difference? Now, this is a really important point to note here. When we talk about a legitimate difference, we consider that to be an exception. And that's something that goes into the calculation of misstatement in a particular account versus something called a timing difference. So what is the difference between an exception and a timing difference? Well, this is table 10-2, and it talks about some issues that you might actually encounter in a confirmation where the amounts recorded by the customer may differ from the amounts recorded by the client. So in one situation, you've got the goods not received by the customer, and you'll notice the potential cause, it says that there's a timing difference. What does that imply? Well, let's assume that I send out a confirmation to a customer, and the customer says, that confirmation is way overstated. We do not have that balance yet, okay? And then I go and talk to my client, and I say, they say that the amount is overstated, and the client says, that's because there was a truck with shipment of goods to them that they had not recorded yet because they had not received it. All right. That is an example of a timing difference. If I just basically leave things unchecked for a little while, eventually this will resolve itself. A timing difference is something that is not true at the point in time in which it was responded to, but eventually will fix itself if we leave things to go through their natural course. So we'd follow up with a client or the customer, and we'd say, did you receive those goods you said you hadn't received yet? And they would say, yes, everything's good. The amount is now correct. Or they would say, no, we still haven't received the goods. I think the client is lying to you. That's a bad thing if that happens, obviously. But the whole goal of a timing difference is to actually determine what is the nature of the difference. And you'll notice for each of these, there's a possibility of a timing difference that could actually be listed. Actually, it's not for each of these, because processing error and amounts and disputes, those are actually just legitimate exceptions. Now, let's take a different example, all right? Let's take an example where I send a client or send a number to a customer. I said, the client says you owe this amount of money. This says, no, we never received those goods. All right. And it turns out that the goods were shipped to a completely different customer altogether. That would be an example of an exception in a confirmation. That would be a legitimate difference because the customer never received those goods. They will never receive those goods. All right. It's not a matter of just waiting for things out and for them to fix themselves. This is an actual exception to the circumstance that we looked at before. So if we look at the situation here, timing difference versus goods delivered to the wrong customer, this is something that will work itself out over time. We don't think of this as an exception. We think of this as something that will be fixed shortly versus this is a legitimate exception. This is a legitimate issue. And so the examples of this, other than timing differences, these are all legitimate issues that we might experience in accepting or in confirmation and things that we would record as exceptions. Now, if you remember back when we talked about this from a sampling perspective, we talked about how do we actually determine what the amount of the exception is. We would identify within our sample testing, there's a certain amount of misstatement, and we would extrapolate that to the population as a whole. Does everybody remember when we talked about this in sampling, saying variable sampling? We say, if there's $1,000 misstatement in $1 million population, what does that mean for the entire, or $1,000 misstatement in $1 million sample? What does that mean for the population? And the answer is, we would just use our sampling techniques to actually determine what we believe the misstatement is for the population as a whole. That's what we used the sampling for back then. So determining what the amount of misstatement is going to be really, really important because that's actually going to affect what we believe the misstatement to be for the population as a whole. All right. Last thing to say here. Let's say that we as auditors have sent out confirmations and we've done our best, but we still can't get customers to respond. Okay. We still can't get customers to actually reply to what it is that we're sending out. We're really, really concerned about whether or not they've actually identified or they actually exist or whether they've identified the information. Do we basically say, all right, well, this is an exception, we have to write the whole thing off? The answer is not necessarily. If we as auditors can find other ways to test the accounts to perform alternate procedures, then we can accept these amounts are accepted or valid. So what are some possible alternative procedures that we could actually look at? We could look at examination of subsequent cash receipts. So we not receive anything from a customer. The customer does not respond to determine if their account's correct. But then we look and see that the customer has mailed in checks during the current period of a certain amount, and those amounts match what we think the confirmations are amount. That's strong evidence that the customer did owe an outstanding account balance to our client. All right. So that's one point to note. What about examination of shipping documentation? So we look and say these items were sent out to the customer, they were shipped to. It looks like that there was actually a valid business purpose for this for the amounts that the client recorded as accounts receivable. That's not as strong because again, it's possible they could be shipping out to customers that don't exist, or they could be shipping goods to somebody who's liquidating those into something else. But for the most part, that's still going to be evidence that we could use. And then possibility of any other client documentation that would support the existence of these confirmation amounts. So anything that we can actually look at for documentation to support this. Basically speaking, if we can apply alternative procedures to prove that the confirmation amounts are correct, then it's okay that the customer is not going to respond to the confirmations. If we're unable to do so, then that we would consider that to be a form of a scope limitation. All right, and that finally does it for chapter 10. Now we're going to move on to chapter 11. The good news about chapter 11 is that much of the things that we talked about in chapter 10, oh, I forgot to do the best part. My gosh, I'm so awful about this. I know this is just taking up time, but I can't forget to put the meme in there. It says, isn't confirmation just a bunch of prisoners line up? And it says, no, Stacy, you're thinking of conformation. Okay. You got to help me out, guys. It's Wednesday. Okay. You got to help me out. All right. All right. Let's go to chapter 11. So what did I say about revenues? Revenues are generally the area of every misstatement that we have focus on a lot as auditors, because traditionally speaking, a lot of fraud has occurred in the revenue process. So we're getting to the purchasing process, and basically we have no risk of revenue or fraud in the purchasing process, right? No company has ever committed fraud over purchases. That's not a correct statement, right? Okay. So, oh wait, I forgot about this one right here. So everybody heard of this company right here, WorldCom? So this actually didn't get the acclaim of Enron, but it was a much larger fraud than Enron. It was about a year later, and it was still Anderson. So just a little bit of background on WorldCom. They did not commit a revenue fraud, but they did commit a multi-billion-dollar fraud. And the way they did it, so a little bit about their business model. So they were a telecommunications company. And at the time, early 2000s, there was a lot of infrastructure going into telecommunications. In fact, most of the infrastructure that we have nowadays is a result of these telecommunication companies putting the wiring and the items in the ground that we actually use for communication nowadays. But it was a regionalized process, so only certain regions could operate, or certain companies could operate within a region. And if a company like WorldCom wanted to actually work with customers in a region that was outside of their main area, they would actually have to pay other companies that own the infrastructure. So I don't remember exactly where WorldCom's infrastructure was. I think it was the northern Midwest. Okay, I believe I could be completely wrong about that, but let's say that they had a customer base in the South they started pandering to. And so they find out, all right, we got customers in the South that want to actually use our services. They can't use this infrastructure that WorldCom owns because their infrastructure is all in the Northwest. They would pay something called line charges to the company that did own the infrastructure down there. So we'll say ACCT owned the infrastructure in the area that they are operating in. WorldCom would pay line charges to basically rent the infrastructure from use for ACCT. So that sounds pretty straightforward, right? From an accounting perspective, what do you think the proper accounting treatment would be for line charges? How would we recognize that? What type of account would we recognize that on a financial statement? What do you guys think? We got 5 possibilities. We got assets, we got liabilities, we got equity, we got revenues and expenses. What do you think line charges would be most likely to be recognized as? Equity, obviously, right? Okay, come on, guys. It's not that hard. It's an easy question. It starts with the letter E, but it's not equity. Expenses. Okay, expenses. In fact, that's what the law said at the time, is had to be recognized as expenses. All right. That's not what WorldCom did. Okay. So keep in mind when we have cost for something, that there's 2 possible ways you can treat the cost. You can expense it when it's incurred, which is basically what they're supposed to be doing. Or what you learned back in 221 in Dr. Otero's class, if you recognize something as inventory, what do we call that process of putting costs into the value of an asset? What is that process called? Capitalization. Yeah, capitalization of an asset. That's what they did, is they said, oh, we're actually generating assets here and we're capitalizing our line costs. So instead of recognizing all of the line costs in one period, which an individual line cost may only be $1 or $2, but if they've got hundreds of thousands, if not millions of these line costs, then that's hundreds of thousands, if not millions of dollars. Actually, I shouldn't even say that because I know that the eventual result was billions of dollars. So they are basically taking these really small transactions and capitalizing them and expensing them over time instead of expensing them when occurred. What happens when you take something that should be expensed when occurred and you expense it over a longer period of time? What happens in the current period? Your income goes up. It goes up because you have fewer expenses in the current period. And that's why WorldCom looked like they were such great performance. And then the auditors were saying, yeah, something's going wrong here, but we don't really care enough to do the work. Then the internal auditors investigated and say, yeah, this is not right. They're doing something wrong. And they were found out, and it was the largest bankruptcy at the time. I believe it was $100 billion, roughly around $100 billion, which Enron before that was like $60 billion. Okay. They only had to wait for like about 7 years for Lehman Brothers to come along and say, yeah, we can beat that. Yeah. $700 billion. That's what we're on about. By the way, everybody, Lehman Brothers is still the largest bankruptcy in US history after almost 20 years. $700 billion. That's a lot of money. Anyway, I'm getting off track. We got to get back on track. Let's go ahead and start talking about the purchasing process. So purchase transactions usually involve a recognition of an expense and a corresponding liability. Everybody makes that makes perfect sense, right? Everybody's just like on board, says that's exactly how I do accounting, right? Is that how you all do accounting? Okay. Everybody's just like really like, I don't know, Dr. Barnes, it's Wednesday. It's Wednesday and the sun is shining out. I don't want to be in auditing. That's fair. That's fair. But we do have to talk about this because it's really important, because that's not how we think about accounting. All right. Think about it naturally. All right. So simplification of this process, we could actually use a simplified model and actually have something that meets this. All right. Let's say that I have custodial services for my organization. How would I recognize custodial services if I'm going to pay them at some point in the future? I would recognize like custodial expense, and then I would credit like accounts payable, something like that. So that meets this model of an expense and a corresponding liability. But is that traditionally the way that we do accounting in many scenarios? That's a very specialized scenario. What about the scenario where I do like a purchase of items, like purchase of assets? We'll say supplies, okay? So I do a supplies purchase, I debit supplies, so that's my asset. and I credit supplies payable or accounts payable. We'll say accounts payable for simplicity. So you're saying right there, we have the liability recognition, but there's no expense recognition, right? So has anybody ever heard the term that assets are just unexpired cost? Have you heard that as a definition for assets? I hope so at some point in accounting, but it may have been really, really small. But that's basically how we're going to classify expenses within this category, is that expenses are basically the recognition of the costs of assets. So assets are an expired cost, expenses are expired costs, okay? So what happens to supplies when we use them? Well, they get used up, and how do we treat them from an accounting perspective? We start crediting our supplies account, and we start debiting supplies expense, okay? So there is a corresponding expense, it's just deferred from the initial liability recognition, which is important to note because we have to know the accounting treatment and how this works, it's consistent. We should always see a corresponding expense and liability recognition within the purchasing process. That's one of the accounting treatments, the goals that we have. All right. Most liabilities occurring in purchasing are trade accounts payable. Same thing we talked about before. These are just accounts payable. They use that terminology, but we're just going to shorten it and use the standard terminology. Other items are accrued as liabilities at the end of each accounting period. This actually will become a lot more common within complex accounting treatment. You'll see the term accrued liabilities as kind of accounting nomenclature for anything that's not disseminated into a specific account category. So that's just kind of a point of notion, is that we will see accrued liabilities a lot more frequently moving forward. So auditors need to understand basic matching and recognition concepts to understand the purchasing process. So what does the matching principle tell us? Remember matching principle back from 220, one of those things that you learned about accrual-based accounting? What does it tell us about expense recognition? Expenses should be recognized during the period that the related revenues were incurred. Is that correct? I'm asking you legitimately. It's been a long time since I've taken 221, or at least or 220. This is my equivalent. So can we say that's a pretty good approximation of the matching principle? Yeah, match revenues and expenses together. So it's important to note that, okay? Now, going a little bit deeper, let's talk a little bit about expense categorization, or how we can actually classify expenses. So statements on financial accounting concepts number 5 has 3 categories, and these should look familiar even though the wording is a little bit verbose. Expenses that can be matched directly with specific transactions and events are recognized upon recognition of revenue, okay? So the way to think about these is these are product costs. So capitalization of cost into inventory, when do we recognize those expenses? When the inventory gets sold, okay? Remember, you recognize those inventory costs, materials, labor, overhead, and you put those all into the cost of inventory. Once the inventory is sold, it gets recognized as cost of goods sold, okay? So that's how we recognize product cost. Expenses that are recognized during the period in which cash is spent are liabilities for goods and services. Such expenses cannot be directly related to specific transactions and are assumed to provide no future benefit. So these are period costs. These are different from product costs in that we expense them immediately when they're incurred. So the example of these are items that cannot be directly traced to some sort of ancillary revenue benefit. So we would think of those as the example would be those line costs that I was talking about earlier. Remember, I said those had to be expensed when occurred, and when incurred, not occurred, when incurred. That would be an example of a period cost. The other type is one that you're familiar with, expenses that are allocated by a systematic and rational procedures to the periods during which related assets are expected to provide benefits. The examples of these are going to be depreciation, depletion, and amortization. So we recognize the asset over the assets decline in use over time, whether that be depreciating the asset or whether that be depleting a resource or amortizing an intangible asset. Whatever the process may be, that's how we recognize expenses associated with that. Okay, so that's our primer on expenses and liability recognition. Let's go ahead and get into some things that we've talked about already in chapter 10. So let's get into the analysis that we looked at before. So remember, we had 3 types of transactions in the sales process. We had a sales transaction, we had a cash receipt, and then we had sales returns and allowances, okay? Sales returns, but I also included allowances there. Can we flip that for our purposes here? And the answer is yes. If we think about we're no longer the vendor, we're now the customer, and we're receiving something from a vendor, we can actually think about this from that perspective. So instead of having a sales transaction, we now have a purchase transaction. Instead of a cash receipt transaction, we have a cash disbursement transaction. Instead of having sales returns and allowances, we have purchase returns and allowances. And all of these are pretty intuitive and straightforward. You will notice the accounts being affected are a little bit different than the ones that we looked at in sales revenue. So accounts payable inventory, that's probably a little bit. Accounts payable is pretty straightforward, intuitive. Inventory is a little bit less intuitive. Keep in mind that we could be purchasing inventory, if we'd be purchasing the capitalization of cost for inventory. We can actually recognize purchase or cost of goods sold because we know that the accounting treatment for that is a little bit sporadic based on whether you have a perpetual inventory system or a periodic inventory system. And then various asset expense accounts. Cash disbursements are pretty straightforward. We do have cash and accounts payable. Those accounts payable gets written off once you actually distribute the cash to whoever it is you owe. This is also, we recognize cash discounts from our end. Okay, that's where we take the benefit of that 1/10 N/30. And then purchases and returns and allowances follow the same pattern before, although we do have various expense accounts that can actually affect this process as well. Types of documents and records. The nice thing about these documents is they're all fairly self-contained, plus they should be fairly familiar to you. Does everybody remember chapter 6 when we did the test of controls homework and I said you were going to pick up those voucher packages and look at the requisition, the purchase order, the invoice, or the receiving report, and then the invoice, and we had to match all those documents as part of test of controls? Those were actually from chapter 11, okay? And so those documents should look fairly straightforward to you. There's a little bit more broad documents that we could actually be looking at before. The voucher itself contains all the documents itself. The voucher register is just a list of those. We also know there's subsidiary ledgers as well as payments that occur subsequent to that. But for most part, this is a fairly straightforward list. It's a lot less detailed than the list that we looked at for the revenue process. And I think most of these we could define, if not formally, at least somewhat informally, we could define these all within this course. Okay, major functions. We have requisitioning, purchasing, receiving, invoice processing, disbursements, accounts payable, and general ledger. So requisitioning is basically at the department level where we have departmental goods requested for use. Purchasing is where we say, all right, can the department have those goods or not? We have to review the process and make sure that we understand whether the department needs to have those goods. Assuming that the approval takes place, then those goods are shipped out and to be received for use by the departments. The invoice processing actually receives the vendor invoices and actually makes a determination when those invoices will get paid. Disbursement is the payment of those invoices. And then accounts payable and general ledger, those are just our recording functions at different levels. Like accounts receivable, accounts payable is at the subsidiary level. The general ledger is at the aggregate financial statement level, or the system level. Okay. So what did we do last time with these? What do we do? Remember everybody, we did this on Monday. I said, let's go ahead and take a look at these from a segregation of duties perspective. I'm going to give you the same disclaimer I gave you on Monday. It is not a clean designation for some of these as to whether it falls within custody, authorization, or recording. But the easiest way to approach these questions is to be able to look at them and to be able to understand at a basic level, what is the primary focus of this particular area, okay? And you're going to notice right away that requisitioning creates a problem because it has both initiation and approval, okay? At the department level, we probably would have some sort of approval within the department for the process. But requisitioning at a very basic purpose is going to be a recording function. Then we have purchasing, and purchasing starts out by saying approval of purchase orders. What's another word for approval? Authorization, yeah. Hopefully, well, you could have found a different word for approval, but I think you know what word I was leaning towards. It was one of the 3 words that we're trying to focus on for segregation duties. Then receiving goods. Goods are assets. So what is the functional area for receiving? Yeah, no, another word together. See, but you're right. Custody of assets. Very good. And then invoice processing is a little bit different. This is the one that I said was a little bit antsy. When we talked about billing in the revenue process, I said this is a recording function. Are we recording anything as part of invoice processing? And the answer is not really. We are waiting for a record to come from our vendors. They're the ones responsible for sending documents to us, not us generating documents for somebody else. So invoice processing is more about when do we pay and when do those transactions get authorized to be paid. So invoice processing is really more of an authorization function than a recording function. Now, are there recording elements? Certainly, but again, we're trying to simplify this process. Disbursements, what are we dispersing? We're dispersing cash. Cash is an asset, so this is going to be what type of function? Custody, okay, and then accounts payable and general ledger. Remember, these are going to be redundant recording functions. All right, so let's just do 1 or 2 of these, okay? This is our key segregation duties. So purchasing function should be segregating for the requisitioning function and the receiving functions. If one person is responsible for requisition, purchasing, and receiving, fictitious or unauthorized purchases can be made. This will result in theft in goods and possibly payment for unauthorized purchases. How do we prevent theft of purchases or unauthorized purchases from taking place? We separate out purchasing requisitioning and receiving. So we said purchasing, that was the second step. After we identify what is needed, we go through an approval process. So that's going to be our authorization function. Requisitioning, that was when we say the departments are going to actually request goods. We said that was mostly a report or recording step. And the receiving, that's where we actually get the assets. That's a custody step. So guess what? We're separating out all three responsibilities here: custody, authorization, and recording. All right. One more. Let's just go ahead and do this one. Invoice processing function should be segregated from the accounts payable function. If one individual is responsible for invoice processing and the accounts payable functions, purchase transactions can be processed at the wrong prices or terms, and or cash disbursement can be processed for goods or services not received. It can result in overpayment for goods or services and theft of cash. So invoice processing, I said this was primarily what? Custody, authorization, or recording. I said this is primarily authorization. Yeah, primarily authorization. And we're separating it from accounts payable, which is primarily recording. So we're separating out account or authorization and recording. By the way, if you're sitting there and saying this all makes perfect sense to me, good, because you'll be very well prepared for the exam questions that I'll ask in this area. If you're sitting there saying, I would rather be doing anything else than this right now, I get you, but this is really important to make sure I understand, because there will be exam questions about segregation of duties on the exam. So make sure that this at least flows somewhat intuitively for you, that you actually understand that the segregation of duties areas are and why we need to separate out these responsibility areas. Okay. Moving on to inherent risk assessment. The good news about purchasing is we have fewer inherent risks related to purchasing, and they're pretty common with what we talked about with respect to revenue. So what we've identified with revenues are going to be consistent with what we identified for purchasing. Those are industry-related factors. Remember, we talked about revenues and industry-related factors. If you have a new competitor into the industry, that can be problematic. Can a new competitor into the industry also be a threat to your purchasing scheme? Certainly. You've got somebody who's actually requesting goods from the same supplier that you normally would. The supplier now has demands on its time and resources. It could actually increase the cost at which they're going to generate those goods and services for you. So industry could actually be an area that affects your purchasing power as well. And then misstatements detected in prior audits. Okay. If we see problems in previous periods, those are going to flow over to current periods. All right, what did I say about the strategy for purchasing? I said this on Monday. I said, are we going to use a reliance strategy or a substantive strategy? Yeah, I know it's a reliance strategy. Everybody's really, really sad. Okay, that's good. Okay, keep your sadness. Okay, keep your sadness. I promise that it will go away in about a week. Okay, we will use a substantive strategy. Well, about a week and a half. Okay, but right now everybody's really, really angry that it's still a reliance strategy, and I get that. Okay, but it's really important to understand why it's a reliance strategy. How many transactions do we process through the purchasing process? Is it going to be a few or a lot? It's going to be a lot. Okay. So can we say that would rather rely on the client's internal controls to be able to provide us assurance for these transactions? I would say that we probably would like to rely on the client's internal controls to some degree, because testing all those transactions ourselves would be nearly impossible. So for the most part, we need to gain our assurance through the client's controls, which means we're going to be testing internal controls. Okay, here are our assertions. All right, here's our control sequence. You can take a look at it and marvel at its incredible simplicity and awe. And then let's talk about the control sequence. Again, there are multiple tables. We got 2 more tables to add on today, because remember last time I said tables 10-6 and 10-7. So now we're on Wednesday, we're on 11-6 and 11-7. So for purchase transactions, what do you think probably the most relevant reliability, the most most relevant assertion would be for purchase transactions? So for revenue transactions, we said that existence occurrence was our primary assertion, our assertion of concern. What would be our assertion of concern for the purchase transactions? Our primary assertion of concern? Probably completeness. It seems logical that if we have a client, that they would probably try to underreport liabilities and expenses rather than overreport them. Does that sound reasonable? If you were doing your own financial statements, would you want to underreport your liabilities or overreport your liabilities? So I got billions of dollars in debt. I'm not afraid, Dr. Barnes. Yeah, that doesn't seem like a rational approach. So we're going to say underreporting is a concern, so completeness. All right. So what's an example of this? Purchases made but not recorded, or purchases made not recorded. That's pretty simple and straightforward, but it's a really important one. We'll talk about why here in just a second. So a purchase gets made, but it fails to go in the system. We are concerned about that. So we say, what do you do about that to address that particular risk, client? And they say, we make sure that we match our receiving reports to vendor invoices when they're entered in the purchase journal. Okay. So we have a matching process in place as a control for this. What do you guys think? Does this sound like a pretty reasonable control? I threw it on a slide, so I'm hoping so, okay? But a matching process to make sure that if we have a receiving report, we get an accompanying vendor invoice. We don't just have receiving reports sitting on the ether, always open and never doing anything. All right, so how are we going to test that as auditors? All right. What if we trace the sample of receiving reports to the respective vendor invoices and vouchers? So tracing, what direction are we moving? We're tracing bottom to top. Okay. Does that make sense? Letter T pointing upward. Okay. If we're going from receiving reports to vendor invoices and the subsequent vouchers that are created from those, does that actually seem like a reasonable direction? Is that going from source to later source or records? Yeah, okay. I think tracing is used correctly here. And if that's the case, this would be a reasonable test of controls. All right. Reasonable test of controls in this area. All right. Clear? Everybody got that one? That's okay. I've got another one just for excitement. Okay. Just for excitement. So we got cash disbursements. This one's one where cash disbursement gets made, but it never gets sent out. So we're really concerned about existence occurrence. So does cash disbursement gets recorded, but doesn't actually get made. So the opposite problem occurs here. So we say, all right, we've got the cash on hand. We're going to send this to the client. Go ahead and make the payments. And they put it in my hands. And instead of giving it to the client, I give it to my bank account because that's the way that I am. So cash disbursement gets recorded, not made. What is a way to prevent that from occurring? Well, the client's going to say, we're going to provide monthly bank reconciliations to prepare and review on those. Now, I don't think this is the best control, but I think this is a relevant control in this area. What did you guys remember 302 when you did those bank reconciliations? What was the goal of that? It's to identify any discrepancies. When you identify a discrepancy in your own bank account, do you further investigate it? It's like, no, I've got a check for $1,000 here. I don't care. I'm loaded, Dr. Barnes. And it's like, no, you're probably just kind of like, all right, $1,000 check. I don't know where that came from. Let's investigate, try to figure out what's going on here. All right. So bank reconciliations prepared and reviewed. So what are we going to do as auditors? Can we test bank reconciliations? By the way, the spoiler is answer is yes. In fact, we're going to learn how to test bank reconciliations in a few weeks. Okay. When we get to chapter 16. I think it's chapter 16. Yeah, chapter 16. We're going to talk about how to test bank reconciliations. So we're going to view those bank reconciliations for indications of independent review. We'll learn about how the testing of bank reconciliations works, but this would actually provide a lot of assurance to make sure that they're doing an oversight process to make sure the transactions are just not occurring out of the ether. So yeah, again, just as a reminder, these are simplistic versions of this. Please make sure you review the tables on in chapters 10 and 11 to get a better understanding. I don't think you need to memorize the tables. I think that's a impossible task given the size of the tables, but you should have a good understanding of how the assertions relates to the controls and the test of controls for all assertions, not just for completeness and existence occurrence. Is everybody on board with that? Okay. All right. As I said before, when we talk about purchase returns and transactions, when we did the sales returns and transactions, we said these were largely not material. And that's true here for two. If we got a lot of purchase returns and transactions for a client, we would have problems then. So that would be a first red flag. But in most situations, because these are not material, we're generally going to limit our testing in this area. We can oftentimes rely on substantive analytical procedures to provide some sort of testing and assurance in this area for us. So generally speaking, test of controls are not really that important in this area. Speaking of substantive testing, let's move on. Okay, remember we're moving on to our account balance assertions. We need to actually consider those both in context, not with just the account balances, but also the transactions and events. So all of our assertions are now relevant. Now, substantive analytical procedures over the purchasing process. Generally speaking, the rules that we talked about for the revenue process hold here too. Using these for general purchase transactions, like for if we want to look at inventory amounts or if we want to look at cost of goods sold, trying to develop an analytic to estimate those amounts is not going to be effective. We can use this for models in smaller areas, particularly those that are ancillary related. Like if we have expenses, like interest expense would be a good example, although that's really not part of the purchasing process, but some other ancillary area that's smaller in that we can develop an expectation. What's more likely is that we're going to rely on trend analysis and ratio analysis to develop expectations for areas that we should investigate further. So as you can look at here, when they talk about the analytical procedure, they say compare payables turnover and days outstanding accounts payable to previous years and industry data. So this is an example of looking at ratio information over a period of time. So it's ratio and trend analysis combined. What does that tell us? It says if we think that there's changes in these ratios, massive changes in these ratios, we might want to ask the question why these ratios change so significantly over time. And it's consistent with what we look at. It says basically all of these are examples of comparing amounts from the current year to the previous year. We can predict accrued interest expense based on loan terms and outstanding balances. We will talk a little bit more about that when we actually get to the long-term debt chapter, because usually speaking, that's going to be more relevant in long-term debt than it would be for the payables process. For most part, the examples of substance available procedures will be up here. Like I said, ratio analysis and trend analysis, oftentimes the combination of those two. Okay, so completeness. What is going to be our concern with completeness? Remember, we talked about completeness being the most important area with respect to assertions in the purchasing process. And the answer why, it's more likely that a client will underreport their liability and expense transactions than they will overreport. Okay, and it makes perfect sense why, because if you underreport expenses, then what happens to your income? It goes up. Okay, so we want to be very, very sure that all obligations have been properly recorded. Any obligations are recorded to the entity. Now, you will notice here that I've got these words, search for unrecorded liabilities listed out, okay? Search for unrecorded liability, we're going to talk about that in a little bit, but I want to assure you right now, this is a legitimate thing. This is not just words that I wrote on a slide and made up. Why do I mention that? It's because somebody actually asked me to do the search for unrecorded liabilities during my first audit engagement. I didn't remember this back in my auditing class. I thought he was trying to haze me, and I said, yeah, that's not a real thing. Yeah, it is a real thing, okay? We're actually going to talk about how to perform that, okay? Existing occurrence, all recorded liabilities are valid obligations to the entity. So even though we are not as concerned about making sure that they don't overreport liabilities, we want to make sure we still test it, because that would be bad business to overreport liabilities or obligations. Valuation, allocation, accuracy. All accounts payable are recorded at their proper value, okay? So we want to make sure that they're recorded at the correct amounts. They also want to make sure that accounts payable are obligations of the entity, which again is just the definition of a liability. Want to make sure they have the obligation to make those payments. Presentation, all necessary disclosures related to purchasing transactions and accounts balance have been made. Then classification, this is going to look really familiar. This looks a lot like what we talked about with respect to accounts receivable, and it is. It's just same philosophy, just on a different direction. We want to identify and reclassify any material credits contained in accounts payable. If we owe one entity a material amount of money, we generally will not consider that to be an accounts payable anymore. That's going to be something, a different type of payable that's much more material in nature. Okay, so we have to be very, very careful about any large amounts that are owed. We also want to make sure that short-term and long-term payables are recorded properly. Is it possible to manipulate accounts payable to improve your credit or to improve your current ratio? Yeah, so what if I said, I'm going to take these current liabilities, I know that I'm going to pay them within the next year, but I'm going to reclassify them as long-term debt, reclass them as long-term payables. What happens to my current liabilities when I do that? Current liabilities go down. What happens to the current ratio when current liabilities decrease? It goes up, okay? I've just taught you how to commit fraud. Congratulations, guys. We've had a lesson today. All right, so we want to make sure that short-term and long-term payables are properly classified for the same reasons, although usually different directions. So we talked about for receivables. Also, along the same lines, we want to ensure that different types of payables are properly classified. Then finally, all purchasing transactions and related accounts payable are recorded in the proper period. By the way, if you think cutoff is kind of an afterthought, you actually have two problems on cutoff for your homework. One of those for revenues and one of those for purchases. The purchasing cutoff testing is actually really easy. The revenue one, not so much. Okay, so it may require a little bit of effort and a little bit of diligence on that one. Okay. What were the last things we were talking about? I've been going at such a frenetic pace. I'm trying to make sure we get it all. I'm checking, make sure that we get it within time. All right. Search for unrecorded liabilities. Okay. So search for unrecorded liabilities involves tracing payables to balances to year-end to subsequent cash disbursement. So when I say tracing, what is the assertion that I'm talking about here? This is foundational stuff that you have to remember because it's really, really important. What is tracing referring to? So tracing is the letter T, okay, reporting up. So we got moving source to record. What direction is that? So it's moving up. Which directional assertion are we talking about here? Are we talking about completeness or existence occurrence? 50-50 chance. Give you a hint. It begins one that begins with C. Completeness. Yes. Wow. I knew you guys get it if I gave you enough hints. Okay. But no, it makes sense because we're trying to make sure that they're not underreporting liabilities. What did we say earlier? The reason completeness is so important is because a client may fail to record their expenses or their liabilities to improve their financial position. So we as auditors, we're going to make sure that they don't have liabilities that are unrecorded. How do we do that? Well, I'm glad you asked. Okay. So This next step talks about if an unrecorded liability might exist, what we do, but let's actually talk about what you will be doing for your homework, okay? I'm going to talk about 4 scenarios, all right? First scenario, I've got a client with an existing, or sorry, we'll say a vendor with an existing balance of $1 million, okay? And my client, after year end, makes a payment to that vendor of $1 million. What do we as auditors think about that? So you had a year end balance of $1 million and our client pays them $1 million. How do you feel about that? I have no opinion whatsoever. You're just like, that's cool. Yeah, it is cool. Okay. They're owed $1 million. They're paid $1 million. That's actually perfect. Okay. Second scenario, they're owed $1 million. Our client pays them $500,000. What do you think about that? Is that reasonable? Certainly. Okay. We can have clients that pay off part of their balance. They don't have to pay off everything, but they're making a payment on part of what they owe. So everybody good with that? All right. Let's say that I've got a client who has a vendor with $1 million balance. And then immediately after period end, they pay them $2 million. What do you think about that? How many of you all have ever paid more than you actually owed for stuff? It's like I tip all the time, Dr. Barnes. Isn't that the same thing? It's like, okay, ignoring that, okay, ignoring that. How much frequently do you do that? If you owe somebody $10, do you pay them $20 and say, you know what, you're my friend, you deserve it? Or do you pay them $10? Good business would say pay them $10. So if we got a client that's paying more than they owe, is it just because they're nice people? Or is it possible that they actually have a liability that they owe, but that's not been recorded? That is where the question comes up. Now, this does not mean that an unrecorded liability exists. It means an unrecorded liability may exist, okay? So a vendor has a balance of a certain dollar amount, and they're getting paid for more than that amount. That's where we've considered the liability may exist. Fourth scenario, a vendor has a $0 balance, and they get any amount of cash paid to them after the period end. What do we think about that? So they have a $0 balance, they get paid $1 million. Like, why are you paying this vendor $1 million? You don't owe them anything. And the client may say, well, we definitely didn't not record a liability. That's where we'd say we want to make sure that we check and see that an unrecorded liability doesn't exist. So in those last 2 scenarios, that's the possibility that a liability may not have been properly recorded. If that's the case, our auditor is going to basically say, we're going to examine the data of the receiver report and the vendor invoice to determine if the liability relates to the current audit period. It's possible that they could be making payments for items that occurred during the subsequent period. So there's a cash disbursement on January 2nd for $1 million, but there was a purchase on January 1st for $1 million. So that's a possibility, okay? That's a possible explanation. We also want to review the unmatched purchase orders, receiving reports, and vendor invoices for any unrecorded liabilities. So maybe there was something that was just a failure to actually record a purchase that took place, but they got the invoice later on and they said, I better pay this invoice. If that's the case, we want to make sure it's a legitimate payment for an invoice, so they have to record that liability. Now, I know that this is really dense and a lot to hold on to, but I kept this in here, even though my bitterness at Dr. Shonio for leaving, I kept this in here because I thought it was so important. Of Dr. Shonio in a purple suit. And if you never got to experience Dr. Shonio in his purple suit, I'm going to tell you how you missed out, but at least you get to see the picture, okay? And he actually, I think he scrubbed the internet of this because I had multiple pictures at one time. I think he actually scrubbed the internet of pictures in his purple suit. But I did get one of him with Dr. Lin, okay? And despite his best efforts to keep it all the record, Dr. Shonio rocking a purple suit continues to be a liability for him and a major asset for all of us, okay? So no matter my bitterness of him leaving, I'm still going to keep this in slides. There's going to be generations, years from now, are going to say, I don't know who this Shonio cat is, but dang, does he look good in a purple suit. All right. Yeah. All right. Last thing to talk about, confirmations. Okay. Confirmation stuff still exists in accounts payable, but usually when we use testing for liabilities and we're testing for even when we're testing for equity accounts, we tend to use a version of the payable that's called our confirmation that's called a zero balance or blank confirmation. Now, this is a positive confirmation, but we don't actually report the amount within the confirmation. All right. And there's a very specific reason why. So we want to increase a degree of accuracy because generally speaking, these confirmations are much larger dollar amounts. Also, we're concerned about misreporting. Let's say that I send a confirmation out to a vendor and they're actually owed $10,000 with the client, but the client wrote $100,000. If a vendor actually sees a confirmation and say the client thinks they owed $100,000, are they going to say, no, they only owe $10,000? If I believe that I owed you $100, but I only owed you $10, would you say, Dr. Barnes, you only owe me $10? Would you say, Dr. Barnes, you owe me $100? Let's be honest, you'd like that $100, okay? Yeah. So they might misreport, which is why we use the blank confirmations to determine what the vendor actually believes the amount is, okay? So keep in mind that this does apply to the same rules of confirmations. Timing differences are still applicable here. If there's a payment discrepancy simply because of the timing of shipped goods, an example, we could actually say the confirmation is still valid, but it's just the existence of timing difference. So the same rules that we talked about earlier in today's class session apply. All right, and I think that does it. And man, it's 2:20. So man, we finished all this in there. We got homework on Friday. We've got a lot to talk about, some intense stuff to go. So I'll let you get at it. Have a good day.